Good afternoon. Here is the one thing worth understanding this weekend. At midnight, the United States imposed 50% tariffs on about $20 billion of Canadian goods after trade talks collapsed on Friday night. Canada's Prime Minister has suspended negotiations and says he will match those tariffs dollar for dollar. That is the loudest story of the weekend. It is not the most important one. The most important thing happened more quietly. This week, Broadcom went looking for as much as $100 billion of debt that will never appear on Broadcom's own balance sheet. And the market that prices the risk of Broadcom failing to pay immediately charged the highest price it has ever charged. The stock market, looking at exactly the same announcement, closed higher. When those two markets disagree that loudly about the same set of facts, the credit market is usually the one that has done the arithmetic. The board and a note on it. Today is Saturday. American markets are shut, so these are Friday's closing levels. Crypto, of course, never closes. The S&P 500 finished at 7,674, up 0.4% on the day. The Nasdaq matched it almost exactly. The Dow added 517 points, up nearly 1%, the best of the three. And yet all three of those indices posted a losing week. Friday was a bounce inside a decline, not a recovery. The 30-year Treasury peaked at 5.337% on Tuesday, the highest level since 2007. Gold closed at $4,587 an ounce, its third consecutive weekly gain, helped by a softer dollar and by the national debt crossing $40 trillion this week. Bitcoin sits near 77,700, up 22% on the week. Crude finished just under $87, a second straight weekly rise. Two more numbers matter, and they are the ones nobody puts on a board. The dollar index slipped to 98.8, and the volatility index closed around 15, down 5.5%. Hold that last one in your mind. Equity volatility is priced for a quiet autumn. In the same week, the bond market touched a 19-year high. First read, consensus says the artificial intelligence buildout is self-funded. The comfortable version of this story is that the largest capital spending program in corporate history is being paid for out of the fattest cash flows in corporate history. Increasingly, it is not. On the 10th of August, NVIDIA announced memorandums of understanding with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR to mobilize more than $500 billion of third-party capital. Read the company's own description of the purpose. The structure is designed to let outside investors fund the build-out without adding directly to NVIDIA's balance sheet. This week, Broadcom went considerably further. Roughly $60 billion of senior secured debt, routed through special purpose vehicles, plus a junior slice near $30 billion, up to $100 billion in total, which would be the largest financing of its kind ever funded, to buy artificial intelligence chips and lease them to customers. Two of the firms in talks to participate, Blackstone and Apollo, are the same names backstopping the NVIDIA platform. This is not a scandal. Off-balance sheet financing is a legitimate and often sensible tool, but it is always evidence of one thing. The sponsor wanted the asset more than it wanted the liability on its books. High conviction. And it is the subject of today's Focus episode. Second read, consensus says Bitcoin's rally is a policy win. Bitcoin had its best 5 days since March of 2024, and the framing almost everywhere is regulatory clarity and a friendly administration. Look at the mechanics instead. Over 24 hours this week, $3 billion of short positions were liquidated against $263.5 million on the long side. That is better than 11 to 1. $1.14 billion of those shorts cleared in a single hour. It was the largest short liquidation event since at least 2021. Now, what does that actually mean? A short is a bet that the price falls. When the price rises instead, the person holding that bet is forced to buy the asset back to close it, and that buying pushes the price up further, which forces more of them to do the same. It is a mechanical cascade, and it is real money moving real prices. But it is a very poor guide to underlying demand, because none of those buyers wanted to own the thing. Prediction markets then repriced off that move. Polymarket now shows 85% odds of $80,000 by year-end, and 25% for 100,000, after pricing barely coin flip odds of a run to 75,000 a week earlier. Medium to high conviction, and one of our own live calls is now on the clock against it. Third read, consensus says the bond scare has passed, and the calm in equity volatility proves it. Here is what actually happened in sequence, because the sequence is the whole story. On Tuesday, the 30-year Treasury touched 5.337%, the highest since 2007. On Wednesday, the Treasury Department responded by saying it would at least double the size of its buyback operations in long-dated debt. Yields fell immediately. And then, as the week wore on, the relief evaporated. Consider what a buyback of your own debt actually is. The government raises money by issuing debt and uses some of that money to purchase older debt back. It improves how smoothly the market functions. It does not reduce what is owed by a single dollar. The market extended that announcement roughly 2 days of credit before returning to the question the announcement was designed to change the subject from, which is simply this: who buys the long end, at what yield, indefinitely, medium conviction, and note the tension on the board. Volatility at 15 says the next 3 months are quiet. The 30-year at a 19-year high says something else entirely. Follow the money, starting with rates and the Federal Reserve. July's Consumer Price Index came in at 3.4% on the headline, down from 3.5%, and 2.5% on the core measure, down from 2.6%. That is genuine, unglamorous progress, and it deserves to be said plainly. And yet the Federal Reserve, under Chairman Kevin Warsh since May, held its policy rate at 3.5% to 3.75% at the end of July, with 3 members dissenting because they wanted to raise rates. That is the tension of this entire cycle compressed into one meeting. The inflation data is cooling while the inflation risks are getting louder. Consider what landed just this week: 50% tariffs on Canadian goods, with retaliation promised, an oil market up for a second consecutive week, a national debt through $40 trillion. September is genuinely live in both directions, and it will be settled by the Middle East and by the next 2 inflation prints, not by any speech given between now and then. Still following the money, now to the dollar and to gold. The dollar index slipped to 98.8. Gold closed the week at $4,587 an ounce, its 3rd straight weekly advance, with the debt milestone and the weaker dollar named as the drivers. You will notice we quote gold as a level with a reason attached, rather than as a performance statistic. That is deliberate, and it is a house rule. The level is verifiable, and the driver is verifiable. The horse race percentages that circulate about gold are frequently measured from convenient starting points, and we do not repeat numbers we cannot stand behind. On the crypto side, the flows tell the same story as the liquidations. The move was violent and largely mechanical, with Ether recovering toward the middle of the 2000s alongside Bitcoin. And the bearish case has not gone quiet. One research firm published this week that until Bitcoin trades in the $30,000 range, it will treat every rally as a bounce inside a downtrend. Both of those things can be true at once for quite a long time, and usually are. A word on sentiment, drawn from market and social sentiment monitoring rather than from any single source. 3 things stand out about the mood this weekend. First, the loudest macro voice in the market is now openly recommending less exposure to government bonds and more to gold, on a debt crisis thesis with a horizon of roughly 3 years. That view has moved from the fringe to the center of the conversation in a matter of months, which is itself information. Second, the crypto commentary has flipped from resignation to something close to euphoria in under a week, and the tone is running well ahead of the mechanics we just walked through. Euphoria is not a sell signal on its own, but it is worth noticing when the enthusiasm is downstream of a liquidation cascade. Third, and most interesting, the technology community and the credit market are now in open disagreement about whether concern over data center financing is warranted at all. One is arguing it is manufactured. The other is charging record prices to insure against it. That disagreement is today's tell, and we will put a number on it right now. So here is the tell, and it is a price rather than an opinion. A credit default swap is simply what it costs to insure somebody else's debt against not being repaid. It is the purest available price of the question, will this be paid back? Broadcom's spread went to 122 basis points this week. That is a record for the company. Now, let me be careful, because the honest version of this is more interesting than the alarming version. 122 basis points is not a distress number. Broadcom is not in trouble. What makes this the tell is what the market was reacting to, not weak earnings, not a lost customer. It repriced on the announcement of a financing structure. The credit market looked at up to $100 billion routed through vehicles that sit outside the balance sheet, understood that moving debt off a balance sheet does not move the risk off the planet, and charged more. The equity market looked at the identical announcement, saw expanded chip demand, and bid the shares. Both of those reactions are rational. Only one of them is paid to think about what happens if the revenue arrives later than the interest payments do. Sectors in play, and 3 are worth your time today: semiconductors and artificial intelligence infrastructure. The bull case is that the demand is real, and Morgan Stanley still models returns on invested capital above 25% on this spending. The bear case is that the marginal dollar now arrives as structured debt rather than as cash, and a record credit default swap print says somebody is charging for that. The read: own the demand, but price the leverage. Second, biotechnology, which produced the single largest move of the week anywhere in the market. Moderna rose 177% in one session on Wednesday, from $63 to $174, the best day in the company's history after its individualized messenger RNA therapy, given with Merck's Keytruda, met its primary endpoint in a late-stage melanoma trial. That is the first positive phase 3 readout for messenger RNA cancer therapy. The bear case is straightforward: 1 readout, 1 indication, and a stock that nearly tripled in a day. The read: the platform question has been reopened, and nothing else on the tape is close to this in significance. Third, energy: 2 consecutive weekly gains, a supply risk premium, and an American policy escalation landing Monday. The bear case is that this premium is political and can deflate on a single headline. The read: this war is a rate story wearing an oil costume. On the radar, Monday is the date to write down. The administration has described the coming measures against Iran as an economic D-Day, with the Treasury Secretary set to detail them, aimed at cutting Tehran out of banking, shipping, and cash channels. The oil premium currently reflects an expectation, not a document. Canadian retaliation should land this week, dollar for dollar, on roughly $20 billion of goods. Watch whether Broadcom's junior tranche actually clears. And at what price? Because that is the real test of this financing template. September the 9th is when the expanded Treasury buybacks meet an actual auction calendar, and the next 2 inflation prints have been named explicitly as the swing input for the Federal Reserve. Now the scorecard, because accountability is the point of keeping one. 3 calls are live from Wednesday: that the Treasury raises the buyback cap again or extends the window before year-end, still live. That the 30-year does not close below 5% before the end of October, live and comfortable. And that Bitcoin does not hold above $70,000 for 14 consecutive daily closes from Wednesday. That one is live and under real pressure on day 2 of 14, with Bitcoin near 77,700. We are not adjusting it. A call you quietly widen when it starts to hurt was never a call. 3 new ones are added in today's written issue. All dated, all falsifiable. The close: if you take one idea away from today, take this one. The most consequential sentence in finance this month was not a forecast made by anybody. It was a structure described in a company press release, designed to let outside investors fund the build-out without adding directly to the balance sheet. That sentence has appeared before, in other decades, attached to other assets. It is not evidence of fraud, and it is certainly not a prediction of collapse. A great deal of off-balance sheet financing is sober, well collateralized, and exactly the right tool for the job. But it is always evidence of one thing, and the thing is worth sitting with this weekend. The sponsor wanted the asset more than it wanted the liability on its books, so the question is not whether artificial intelligence demand is real. It plainly is. The question is this: if the returns are as good as everyone says they are, why does so much of the money have to arrive through a vehicle that nobody has to consolidate? This has been the Asymmetric Daily Brief. Research and education only, never advice. The Asymmetric Signal, 1 contrarian read a day. Subscribe.